Hi, Evan. Tell us about Global X and the strategy we're going to talk about today.
Yeah, thank you. So Global X is an ETF issuer in Australia. We've been in the Australian market as a brand for about the last 12 months, but really as a business, we've been here for more than 20 years. So we're actually the second oldest ETF issuer in Australia. And the strategy that I wanted to talk to you today about is the S&P ASX 200 Covered Call ETF, which trades under the ticker of AYLD. So it's quite a simple strategy, but it does involve the use of derivatives, which people need a little bit of education about from time to time. But the way the strategy works is that it buys all 200 of the ASX 200 stocks, holds those stocks within the fund itself, pays dividends through to investors on all of those stocks, and it also simultaneously sells exchange-listed call options on the ASX 200 index. And so what that achieves is it actually caps the upside of the exposure to the stock portfolio, and in return for that, investors receive some regular income. So they receive an option premium by selling those call options. And we do this on a rolling quarterly basis. So investors will receive a premium above, in addition to their dividend yield, in relation to the premium that they receive for selling those call options.
So for those advisors whose clients are still fearful of the word derivative, can you give them some guidelines as to how to take that fear away?
Yeah, look, I think derivatives have had a bad reputation in some circles, and rightly so. If you look at some of the products that were around in that GFC era, in the hands of retail investors as well. So there's definitely an element of caution, but I think really the key thing is education. So understanding exactly what the risk and return profile of this particular investment is massively important for advisors to make sure that they understand it, but then make sure that they pass that on to their end investors as well.
Do you believe this kind of strategy is suitable in all market conditions, or does it suit environments where volatility is high?
It can actually be suitable in all different types of market conditions, actually. So it really depends what your end objectives are as an investor. So if you're looking at a very volatile market, there may be downside in equity markets tends to be correspond with higher volatility. So you may not want in that case to be necessarily exposed to market downside. But then conversely, when you have something like a covered call strategy, when volatility is high, you're going to be collecting higher premiums, which actually compensate you for taking on some of that downside risk as well. So there's an element of all weather applicability for this type of product as well. So it really lowers market beta, caps out your upside to some extent, but it also buffers your downside. So you're playing within a tighter range compared to a straight equity investment, but then you do have more risk compared with a straight fixed income investment.
How long have you been running the strategy for? And are there similar ones overseas?
Yeah, so Global X, we've been running this strategy since the beginning of this year on the ASX 200. But as an international company and a global ETF brand, we have an extremely long track record in running similar strategies. So our US counterparts have been running these types of strategies for well over 10 to 12 years. And they have a substantial presence in the covered call market in the US. We've also rolled out strategies across Asia and Europe as well. So there's substantial experience within the Global X business around covered calls and associated derivative strategies as well.
Are there other similar strategies or derivative innovation type to what you do?
Yeah, absolutely. I mean, in terms of other issuers, covered call products are pretty standard across the market, mainly with active managers as well. So there's a lot of active covered call funds which will take a view on volatility, on market conditions, and make active decisions around covered calls. On our side, it's a very systematic strategy, so highly transparent. Investors know exactly what they're going to get. And look, in terms of other innovation, there's a lot of different ways that you can sort of evolve the simple covered call product. Different areas around adding protection, so adding put options into the mix to give some downside protection. Looking at extreme risk scenarios, so what we refer to as tail risk is another option, but also taking growth as well. So looking at how you can run a covered call strategy that also gives a proportion of growth to the upside in equity markets as well. So really tailoring for what particular investors are looking for.
Finally, this Income and Defensives Forum is being held both in Sydney and Melbourne. The old battleground of Sydney versus Melbourne fits in well with the diverse set of strategies that are across here. What's your view of the Melbourne-Sydney battleground?
Yeah, I think diversify. Yeah, no, I'm a Sydney boy, but I love the coffee and the restaurants in Melbourne, and don't mind their kind of unusual football game as well. But yeah, I think beaches and sun any day for me is good.
Thank you, Evan.
Thank you.